Things are kind of pulling in opposite directions here. I want to follow up on our chart chat last week in which we talked about tensions within the equity market. I think that's still largely the case. Let's start off here and look at something that a lot of investors think about somewhat bearishly. This is looking at breadth within the S&P 500. Investors like to see a lot of stocks moving upwards at the same time. That's not exactly happening right now. What we're looking at in the top panel here in the blue is the S&P 500 index. That's just your typical market cap weighted index. In the white is your equal weight version of that index, in which the weighting of the companies essentially doesn't matter. So when this thing goes down relative to the S&P 500, that means fewer companies are actually participating in the rally. You can see the bottom panel here. This is the ratio between the two. Great way to just assess how much the regular index is beating the equal weight index, and right now it's beating by the most in some time. For a lot of investors, that spells trouble because it means companies, more and more companies, aren't participating in the rally. And then let's look at this. This chart looks complicated and crazy, but it's really not. It's actually the simplest one we've got here today. Red line here marks the election. Blue, Bloomberg Dollar Index. Yellow, 10-year Treasury yields. White, we're looking at the S&P 500, and purple down there is the Bloomberg Economic Surprise Index. The one thing to look at here is everything has moved down since the election relative to November 7th, except for the white line. The S&P 500 keeps going to highs and highs. All these Trump trades have basically rolled over apart from the stock market. So you could look at that and you could say, okay, here's the one part of the resilient Trump trade that still stands, and that's a good thing. Here's where it might get a little bit tricky if it starts to break down, because right now investors are liking where they're putting their weights. This is looking at Goldman's top 50 most mutual fund overweight stocks in the blue versus the most underweight stocks in the white. This is the spread on the bottom panel, and that spread keeps widening out, meaning the companies that right now mutual fund investors are overweight are actually doing pretty well. Takeaway from this is that there's probably some reticence, guys, for these mutual fund investors to jump out of the market in case things go down, because right now they're beating, and they need to beat because they went through a year and if not more of some pretty bad underperformance.
So they don't want to sacrifice potential performance for a little bit of safety, a little bit of reassurance.
Exactly. I think that's kind of why we see the buy the dip on these type of geopolitical news, etc.
But do the warning signs come from the equity markets, or do they come from other areas? High yield, credit, some of the other things that we've got out there, super benign like inflation as well. So there's other indicators that they need to watch.
And I think that's exactly what the second chart is there, because a lot of those things are rolling over and sending warnings.